Not that long ago, I got a call from a client around tax time, and before he even told me what was wrong, I could hear it in his voice. He said, "Vince, I think we have a problem." Now, this isn't a dramatic guy. He's measured, logical, even keel. So when he says that, I pay attention. He continues, "We just met with our CPA. We owe $15,000 in taxes." $15,000. And I asked what I always ask, "Okay, what changed?" He said, "Nothing. That's why we're confused. No no rental property sale, no business income, no big capital gains." Then I asked, "Did you start Social Security last year?" He said, "Yes." "Did you have taxes withheld from it?" And that's when he went silent. Then he said, "I didn't know I had to." That $15,000 tax bill didn't come from investing or from his investment accounts. It didn't come from the market. It came from something people think is simple, that's safe, government issued, starting Social Security. And over the years, I've realized something. Starting Social Security is not just choosing an age. It's a series of financial ripple effects that most people don't see coming. Today, I'm walking you through the 5 biggest surprises people experience when they start Social Security, the ones nobody explains until after the damage is done. So let's start with one that caused that $15,000 surprise. Surprise number 1, the tax bomb nobody sees coming. Here's what shocks people. Up to 85% of your Social Security benefit can become taxable. Now, that doesn't mean you pay 85% in tax. It means up to 85% of your benefit can be included in your taxable income. And here's the part almost no one knows. The income thresholds that trigger taxation haven't meaningfully changed since the 1980s. If you're single and your combined income is over $25,000, or if you're married and over $32,000, your Social Security becomes taxable. Now, those numbers are from the Reagan era. Today, most retirees cross those thresholds without realizing it, especially if they're withdrawing from their IRAs or 401ks. And here's the kicker. Social Security does not automatically withhold federal taxes unless you request it. So what happens? You receive the full benefit each month. You build your lifestyle around that full deposit. You assume everything is fine. Then tax season comes, and suddenly you owe thousands. It feels unfair because you already paid into the system. It feels confusing because no one explained it clearly, and it feels avoidable because it usually is. A simple withholding election, quarterly estimated payments, or better yet, proactive income coordination. But if no one's looking at the full picture, you could get the April surprise. What happened with my client is we were already withholding taxes from all of its other withdrawals, but we can't set up his Social Security. So that's a bit up to him, but the communication can go a long way. Surprise number 2, Medicare premiums jumping for no obvious reason. Now let me tell you about Susan. Susan retired at age 64. She waited until 67 to start Social Security. Everything looks smooth. Then at 69, she got a letter saying her Medicare Part B premium was increasing significantly. She called and said, "Vince, did I sign up for the wrong plan?" No. She triggered something called IRMAA, Income-Related Monthly Adjustment Amount, which is a complicated way of saying if your income was higher 2 years ago, you pay more for Medicare today. 2 years ago, Susan did a Roth conversion. Now, it's a smart move to lower taxes later, but that spike in income pushed her over an IRMAA threshold. And here's the part that stings. IRMAA works like a cliff. Go $1 over a threshold, your premiums can jump hundreds per month, per person. Married couples can see thousands per year in additional premiums. Most people assume Medicare is a flat cost. It's not. It's income adjusted, and certain retirement moves, Roth conversions, asset sales, large withdrawals, can echo forward in ways you don't expect. The government looks back 2 years. Your income decisions today affect what you pay tomorrow. Surprise number 3, why is my benefit lower than I thought? This one hits emotionally. I had a couple, Jim and Carla. Jim planned to retire at 62. He looked online and saw his projected benefit. He thought, that'll work. He filed, first deposit hits, and it's hundreds lower than the number he had in his head. Why? Because he had been looking at his full retirement age benefit, not his age 62 benefit. That reduction, well, that's permanent. Up to 30% lower if you claim at 62 instead of full retirement age. And that's forever. Now, sometimes filing early makes sense, but most people don't realize how permanent the reduction is. Another layer of confusion, if you file before full retirement age and continue working, there's an earnings test. Earn over the limit, Social Security withholds part of your benefit. People think it's gone. It's not technically gone. It gets recalculated later. But the cash flow distribution surprises people. And then there's the spousal planning. I can't tell you how many times I've heard, I thought I'd automatically get half of my spouse's benefit. And it depends. Have they filed? What age are you? Are you divorced? How long were you married? Is it a survivor benefit? It's all layered. And when the deposit doesn't match expectations, your confidence drops because for many retirees, Social Security feels like the stable foundation. When that shifts, it shakes everything. Surprise 4, the COLA or cost of living adjustment illusion. Everyone loves hearing about cost of living adjustments. Good news, Social Security is going up 3%. Sounds great. But here's what happens in real life. Now, I had a client, Mark, who got excited about a sizable cost of living adjustment increase 1 year. Then January hit. He called and said, my deposit barely changed. What happened? 3 things. 1, his Medicare premium also increased. 2, a larger portion of his Social Security became taxable. 3, inflation and his real life spending outpaced the cost of living adjustments. COLA is tied to a government inflation formula. Your personal inflation is different. Healthcare, insurance, property taxes, food, energy. If those rise faster than COLA or the cost of living adjustments, your buying power shrinks. And because Social Security it often becomes a larger percentage of retirement income as people age, its real purchasing power matters more every year. The surprise isn't that COLA exists. The surprise is that it doesn't always protect lifestyle the way people assume. Surprise number 5, provisional income creates a tax domino effect. This one is a subtle but powerful problem or surprise. Let me explain through a quick story. David retired at age 66. He delayed his Social Security until 70, and then the smart move, he has a higher benefit. At 70, he turned Social Security on and continued withdrawing from his IRA like he always had. He called after tax season confused. My CPA says more of my Social Security became taxable this year, but my income didn't change much. Here's what happened. There's a formula called the provisional income. It includes half of your Social Security amount plus IRA withdrawals, plus your pension, any interest, and other income. Cross certain thresholds and suddenly up to 85% of your Social Security benefit becomes taxable. Here's where it gets tricky. Withdrawing an extra $1 from your IRA can cause more of your Social Security to become taxable. So that $1 withdrawal might actually increase taxable income by $1.85. That creates what feels like a hidden marginal tax spike. People think, I'm in the 12% tax bracket, but their effective rate on that withdrawal is much higher because of how it interacts with your Social Security taxation. This is where coordination matters. The order you withdraw money, when you convert to a Roth IRA, when you claim Social Security, these are not isolated decisions. They stack and they compound. The bigger pattern here, notice something about all 5 surprises. None of them are about the stock market. None are about picking the right mutual fund. They are about coordination. They're about timing, tax awareness, understanding how one lever affects another. Social Security just isn't a monthly deposit. It's a central gear in the retirement machine. And when that gear turns, it moves everything else, like your taxes, Medicare, cash flow, survivor income, long-term purchasing power. Most people don't get hurt because they made reckless decisions. They get surprised because no one showed them the ripple effects. If you're within 5 years of starting Social Security or you've recently started it, here's my encouragement. Don't treat Social Security like a simple checkbox. Run the coordination, look at it alongside your IRA withdrawals, your Roth conversions, Medicare premiums, tax brackets, spousal planning, and long-term income needs. Because small decisions here can cost thousands later. Now, if you want help thinking through this clearly, we've built a simple Social Security and income impact review process. You can just book some time with us below by clicking the link. It's not about selling you products, it's about mapping the ripple effects before they happen. You can schedule time below, and we'll walk through whether taxes are being handled properly, whether Medicare premiums are optimized, whether your claiming strategy supports your long-term income, and whether there are hidden tax cliffs ahead. Even if you don't work with us long-term, you'll walk away with clarity. Clarity in retirement, now that's peace of mind. And peace of mind is worth a lot more than $15,000 in April surprises. Now, if this video helped you, you could also subscribe, because retirement isn't about guessing, it's about understanding how the pieces fit together. And when you understand the system, you can move through retirement with confidence instead of confusion. I'll see you in the next one.